get lucky. Every year I get to talk with you guys in the fourth quarter, November and December, about tax planning. And what could be more exciting, right? Yes. Aren't you all looking forward to tax planning? I mean, last year we talked about it a little bit. We talked about the Scotts. I don't know if you all remember this from last year. We went ahead and took a mythical family, Mr. Scott, Mrs. Not Scott yet, and the 2 kids. And we went ahead and went through based on Huntington Beach's average income for a sole proprietor and a teacher with 2 teenagers. And we showed how if you just had a W-2, your sole proprietor information, how much you'd owe versus if you did some tax planning first. And we went and did their tax planning. We gave them, without changing their take-home, their take-home ended up about the same. We saved them about $6,000 in tax. We got $20,000 into a retirement fund for Scott and not Scott. And we got about $5,000 each down to the children that were tax-free, and they could use it to pay for their own things. They could learn how money works, if you need to do that for your kids or grandkids. Or, since they are taxable income but below the standard deduction, they were able to put that into a Roth IRA to start their own college funds. And when you're talking about 10 or 15 years of $5,000 a year compounding without paying any taxes on it in a Roth, that is a significant investment towards your kids' college or your grandkids. So we talked about it. We said how easy it is. Sounds like we're all prepared, right? Are we all ready for 2016? We're prepared? Not exactly. Because we started at the beginning of 2015 with Congress stomping around and saying they're going to revamp the entire tax system. They were going to change the problems with the Altman. They're going to change the problems with the sunsetting provisions. They're going to change how offshore money is not taxed. Everything was going to change. Does anybody know what happened? Nothing. Zero tax reform.
Luckily for you.
By spring of 2014 or 2015, the Ways and Means chapters, their leaders already came out and said, you know what, this is going to have to wait until 2017 when we have a new president, because the current administration is refusing to accept anything we're suggesting. Now, that sounds good. It means tax didn't change, except there was a whole lot of items that expired. We had the sunset provisions for a lot of things ending after 2014. On the personal side, there's issues with some insurance, health insurance that can't be deducted once it expired. There are sales and state taxes that can't be deducted on your itemized deductions. There is accelerated depreciation on equipment for your businesses that drops down to $25,000 from over $500,000 in some areas. So, big things you have to keep an eye on. So, if this is all changing now, and right now, last year, Congress didn't meet until December, and they wrote them all retroactively. At the end of December, they went back and said, okay, we'll reestablish all these things for 2014. As of right now, they have not done that. It is not even on their schedules. They are too busy dealing with the upcoming election and promising whether they're going to change it to a flat tax or a sales tax or a... See how many times we can change the tax program to show that they still take the same money from everybody. So, what can you do? Well, we have to go back to the traditional tax planning. You are looking at defer or accelerate your income. Are you having a good year? Are you having a bad year? Some of you might know what your tax brackets are. If you're down in the 15 and 10% tax brackets because you're on a fixed income or something like that, this is a great time for you to go and cash out capital gains, because if you're in the 10 and 15, they're taxed zero federally. So that's free money. If you wait till next year, you might have to pay 20% tax on it. Same with your deductions. Do you need to defer them? Do you need to accelerate them? If you take a look at your tax return from last year, on the second page at the very top, it tells you this is your adjusted gross income, this is your itemized deductions, this is your exemption, and this is your taxable income. If your taxable income is zero or negative, it means you might want to see if you can push some of your deductions off into next year. If your lender won't evict you, pay your mortgage payment a month late. Move that into 2016. Any itemized deductions, medical expenses, taxes, insurance, anything that's there on your Schedule A, you might want to move it off. Or the opposite. If you're looking at having a large income this year, then you want to try and prepay some of these things. Send your January payment before the end of December. So that way your mortgage lender will give you the interest on it. Same with your medical insurance, with anything like that. And the biggest thing is the specific credits. Right now, they're floating out there and they're in question. Are they going to give you research and development credits this year? Are they going to give you 179? Can you claim adoption credits? I mean, all of these are out there and different writers deciding how they're going to change them. So if you're going to target one of these, you have to decide which ones you want to go for, if they're available now. Or you may need to keep some money in your bank account so that you can take advantage of it at the end of the year. If they come out on December 20th again and declare you could do 179 again for a couple $100,000, will you have cash available to go buy a new phone system, replace your flooring, make some of these capital improvements in your business? It's tough to do planning in a fluid world like this, so you want to keep in touch with your tax preparer. They will tell you what's going on. Hopefully your tax preparer is already telling you, calling you saying, it's the end of the year, we got to make some plans here. What's your situation? How has your life changed? Because if they don't know that information, they can't tell you what you're doing, and you're going to end up one of those guys just waiting to see whether or not you owe money this year. Never a good thing. If we are looking for the end of the year, there are a couple of things you can do. By December 31st, if you're going to sell or purchase any stock because you have a loss on it, you need to make those transactions so that way you can recognize the losses. A secondary one that's not on here is before the end of November. If you have a loss in a stock and you plan on repurchasing it, you have to have a 30-day window between them, or else the IRS calls it a watch sale, and you don't get to claim the loss. So, plan your stock sales. You can establish new 401ks. It's too late to establish a safe harbor. Safe harbor deadline was October 1st. You can still establish a personal 401k. You can establish profit sharing, defined benefit plans, anything like that. You need it set up on the books before December 31st. You can fund it afterward, though. Any gift taxes, any gifts you're going to give your children. You all have, per person, $14,000 per year you can give to an individual tax-free. Now, I don't have $14,000, and my kids don't need it. But for those of you who are starting to do your estate planning, you're trying to reduce your estate so it falls in the minimum amounts that we are not paying 40% tax on your death, you need to be planning these couple years ahead, and you can be transferring some assets to your children. Careful with that, though, because if you transfer to your grandchildren, there is a generation skipping tax that uses up your universal credit.
Scott and I can help you.
Yes. Talk to Mark. Talk to me. In fact, I'll probably tell you to talk to Mark to make the things. I'm not a lawyer, but we'll help you plan that. Do you have to do any required minimum distributions? If you have reached the 70 and a half, you have to start taking money out of some of your retirement funds. If you don't, the excess taxes on it are 50% of what you didn't take out. You take it or they take it. One or the other. If you're going to convert, if you now look at your year and your taxes are lower than you thought and you've already done a IRA contribution and you don't need it. I've had plenty of clients where they made their IRA contributions all through the year. They come in November and we look at it and you know what? You have a zero tax liability. You gave that $5,000 to the IRA. You don't need that deduction. Roll it over into a Roth. Because that way it grows tax-free. If you're going to do any contributions to a children's college plan, 529 plan. In California, we do not have any tax benefits for that. Some states do. But here, it's really just the fact that you can give a large chunk of money to the children. It can grow tax-free, and they can use it for college. And I don't know if anybody here has incentive stock options, but if you do, or if you have friends who do, make sure you have those executed and rolled over at the end of the year and sold. Otherwise, you might be recognizing capital gains next year. So, what does it mean? Plan ahead. Same thing. Same thing we say every time Ron talks, same thing we say every time Mark talks, same thing. If you don't plan ahead, then you're just hoping that somebody else isn't going to take your money. So, any questions?
Yeah.
Yes,
So, like ballpark, are personal returns less expensive to prepare than business returns? And
Depends on how you mean by a personal return. I have clients that on their personal return they have 35 rental properties and a dozen K1s. It's all a matter of how complex the return is. In general, if your return is just a W-2 and mortgage interest and you're married and have some kids and you're not doing anything else, go buy one of those programs for $50 and file it yourself. Don't pay me. If you come and see me, it's going to cost you a minimum of $800. And you know what? If you go to the corner block stores, that's the same price. I see my clients come from those. We see their last year. It tells you what they paid last year. They charge you per form. And it's not just per form as in I've got a Schedule C and I've got a 1040, but it's, well, you had a Schedule E on your 1040. You had a Schedule A on your 1040. You had they count every single piece of paper, and each piece of paper is $100. You want to be... When you go to a tax preparer, in general, their information should all be exactly the same. We're all following the same rules. Our software all follows the same rules. The question is how much you can communicate to them and how much experience they have so they make sure they pick up the deductions that aren't always asked on those software pieces. So, but in general, for a roundabout, a small S corporation with clean books, we usually charge about $1,000 to $1,200. For an individual who owns an S corporation, their individual return that we usually attach to it runs around $800. So, yeah. All right. Thank you.